The Banking Scene Director's Cut goes behind the scenes, sharing stories and insights to help you build the bank of tomorrow.
Hey, Rick, you were in London last week, and I didn't even get the chance to meet up with you because I was struck down with the dreaded man flu. But you were at Open Banking Expo. How was it?
It was fun. It was really fun to meet a couple of old friends, new friends, and get an update on open finance, open banking, although I had the idea that most of the conversations had already happened the years before. 3 sessions were, on the one hand, we had my own panel on open finance, the global view. Then there was a session that stood out for me because it was completely different. That was consumer finance in 2055, very forward looking. And that's always interesting to challenge because we have our own views. The speaker had his own view. And how far are they away from each other? How much are we aligned? And then another one that really stood out was one on fraud.
So I'm gonna jump into those because it was an open banking expo. So let's start with the open banking one, which was the panel that you moderated yourself. And what I found interesting in your article is that it was very global. And that's great because often we only get to hear from speakers that are very local to our whatever region it is. If it's in the UK, it's very UK focused. If it's in Europe, it may be very country focused where we are. But yours was very diverse. I mean, you had viewpoints there from Brazil, from Saudi Arabia, from Australia, and from the UK. Each one of them sort of a very different approach.
Absolutely. And that's what I loved about that panel. I was honored getting the main stage this year, but I felt even more privileged having exactly that panel because we had 4 people, 4 panelists, 4 countries, 4 continents, but also 4 different approaches in how to roll out that open finance agenda. On the one hand, there was Brazil. Although they got inspired by the UK, they went much further already when it comes to open finance developments. Pix is an example we hear a lot in the payment space, instant payments, and they have been building a lot on that. But there are many other valuable examples, and let me quickly dig into the use cases. Some of the use cases that I shared in the blog. Overdraft alerts, having an app that takes care of your overdrafts and make sure that you can also make the required transfers to avoid the fees of an overdraft was one very good one. Salary portability, especially for gig workers, I can imagine very relevant because often their platform they work on, they try to log them in, provide them with another card, an account, etc. So they start collecting the money on the platform. But if you as a consumer want to use that money through another provider, that portability can be very valuable. Maybe less in our region, but definitely over there. And yeah, there were many other examples like that. Currently negotiating with them to see whether we can have someone of the Central Bank of Brazil also attending our conference in Brussels next year. That would be quite amazing. And hopefully we get many more use cases there. But when it comes to, for example, salary portability, if you have people working, for example, on an Uber platform, and they get the option to start comparing the conditions of Uber for the gig worker compared to other financial institutions, that's where the financial inclusion probably pops in.
Well, I know that the gig economy was something that our speaker at the Art Night, Lisa Russell, was talking a lot about when she was at Cybos, saying, the gig economy face a problem because they do collect bits of money across different platforms, and then there's no easy way for them to prove income if they're wanting a loan or something like. But something as living in the UK that stood out for me was UK seems to have fallen behind in this whole game, and yet a little while ago, UK was, held up as being the poster child for open banking and open finance, and now it sort of seems to have stalled. And it's like, what's your views on where the UK is on this compared to the other international institutions that you had on?
Well, it was fascinating to hear that Brazil got its inspiration from the UK, but that today they have much more things included in the whole open finance agenda. So they took the best practices, they brought it to Brazil, they expanded massively, and already realized that, for example, the equivalent of FIDA that is expected in Europe, that in Brazil, the beneficiaries of that are also the ones that are currently in Europe, for example, lobbying much against it. The biggest institutions are not just the ones that get most API consumption, but also the ones that are consuming it the most, like getting data out of from others. And in the UK, I don't know, maybe it's me, but every time I join another Open Banking Expo, I have the impression that a new committee, a new entity is created to start regulating or to start setting standards for another open finance use case. So maybe we like to talk a lot about it. And we like to talk a lot about success of open banking and open finance. But yeah, I don't know whether we do enough insufficiently building it with a good understanding of the customer behind it.
I agree. And I know that, last year there was a lot of noise about moving from beyond open banking. We've cracked open banking now. Now let's move to open data, open everything. This was in the UK that I'm saying, where they're now talking about electricity data and telecom data and all of this. And I'm thinking, hang on a minute. From what I've read from your panel with the global participants, the UK's got some catching up to do now. That's just my personal impression. Happy
But I
for
mean, looking
anybody.
at those different industries, there was a good example of Australia, where the open finance agenda wasn't initiated by the government, the financial services regulator, but from a consumer and competitiveness perspective, where next to finance, there were also other industries that were forced to open up their data. And because the approach was completely different, had to do with data sharing and consumer rights, data rights, the approach was completely different. For example, payment initiation is not part of their open banking agenda. But they do spend much more time and effort on customer protection, etc., which I thought was pretty interesting. The consumer data right is how it's called.
Yeah, consumer
And they're
rights.
currently looking at account switching enablement, which is underutilized today. And I understand it took a few years here in Belgium too before it became quite a success. But yeah, there you see a big emphasis on data governance, security, etc. Where here we try to make sure that sufficiently, like there is a good framework and a common ground for open banking, having strong APIs, etc. Where in Australia, it's more about data rights and privacy. Then there was Saudi Arabia, again, very different because, well, the banks and politics are often quite intertwined. And that means that the vision is much more aligned, meaning that they can really accelerate the open finance agenda because it requires much less dialogue to find a common ground for quick wins. And there we're also talking about more financial inclusion, but more from an SME enablement perspective. And what was interesting there is that also the principles of Islamic finance were integrated from the very beginning, building a probably more ethical open finance framework to compare to many other examples across the world.
So I'm going to dive just back a little bit to go forward, because I'm actually going to jump off the open finance panel that you that you moderated, because you brought up with Australia, it was all around consumer data protection and things like that, which actually was a nice link to a very interesting panel that you sat in and listened to around fraud. And there was
Well, it was a speech, and a very entertaining one as well, from UK Finance.
And that was, it was very much along the lines of things that we've been talking about recently. both at our own roundtables and in our blogs, and that is that the systems are useless when it comes to if the people themselves are the weakest link in the whole fraud chain. And mainly it's around emotional fraud we're talking about. We're not talking about straight up scammers stealing your account numbers or spoofing your bank account and things like that. We're talking about fraud.
But also that very often starts with the same basis.
Yeah. I mean, well, maybe not. My wife got scammed out of £312 last week. Not scammed, frauded out of £312. No interaction on her behalf, and it wasn't real money, it was tokens. Not crypto tokens either. It was loyalty tokens with a large supermarket over here. She suddenly got an email one afternoon saying, "Thank you for redeeming your £312 worth of tokens. We're glad to see you're enjoying them." And she went, "Say what?" Got immediately on the phone to the supermarket line and said, "I haven't spent these, and I've just got an email to say I've spent these." And the person on the other end was very sympathetic and immediately said, "Please, the first thing," my wife was very upset. She was worked up, was £312. It's not a trivial amount of money. And the first thing that he said was, "Please rest assured your tokens are not lost. We will have them restored after an investigation to prove that it wasn't you that redeemed them." And then she calmed down, and then he took her through the process. He said, "Sadly, this happens often, where scammers are just using algorithms to randomly try numbers. And when they find one that actually has a pot of tokens available," my wife had been saving
Doesn't
them.
sound like the most secure environment.
Well, yes, we'll leave their security up out of the discussion at the moment. But the key thing was that it was a very emotionally charged call. And it made me think, when I'd read your article, about the way that banks go about handling calls from customers who have been frauded, and the way that the fraudsters manage to fraud people out of the money. So just to give you one other small example that I had said this morning, my sister-in-law nearly got frauded this last week because she received a telephone call from what was supposed to be her bank saying, "There's a pending transaction on your account for just over £5,000 for an airline ticket. Was that you?" And of course, she immediately went, "Oh my goodness, no, that's not me. I'm not doing that." And they went, "Can you please log into your banking app and you can see the pending transaction?" And she did so. And then they went on to say, "Now, can you just give us your verification code from your banking app?" Thankfully, her husband was listening because she was talking on speakerphone, and he jumped up and said, "Do not give over that information," made her cut the call and phone back the fraud line. Now, of course, the fraudsters were hearing all of this and they were going, no, we are the fraud line. We are the fraud line." And he went, "No, you're not," disconnected the call. Now, it was an attempted fraud. The genuine fraud line actually confirmed that there was a pending transaction, and if she had given that authentication code, it would have gone through. Now, of course, the fraudsters were playing on her emotions, urgency, because she thought, "Oh my goodness, there's a pending transaction, £5,000. I better cancel this immediately." And she thought, in the heat of the moment, she didn't think clearly about, how do I validate that this is the genuine bank hotline phoning me? So they were playing on her emotions, and they nearly got her to do the wrong thing. And what surprised me is that she's what I would classify as a fairly sophisticated financial services user who actually works for a large bank. I was just shocked that she almost so easily fell for that scam. But how do we stop people from falling for scams like that? What's wrong with what we're telling people? Why are people so easily duped? When we look at the fraud numbers, emotional-based fraud scamming sits right up there as one of the top methods of scammers getting hold of our money.
Yeah, what it was, his name was Paul Maskall, Fraternity of Finance. And one of the key reasons he explained why fraud campaigns don't work is because as consumers, we don't feel any benefit reading it. So we don't capture the message when they say, don't fall for that fraud, etc. We don't think it's about us because we don't see ourselves fall in the trap of fraud until it happens. So one of the things that he said is that we should change the narrative. And when you look at fraud, it's very much like marketing, he explained as well. The only difference with marketing is the intent. Yeah, and of course, the legal implications. Fraud is absolutely illegal. Marketing is legal. But the tricks they use in convincing people that fraudsters are actually doing the good thing, they use the same box of tricks as marketing people do. And what he explained is, so we as people, we have an overconfidence bias. We are convinced that we'll never fall in the trap of criminal manipulation. But by making the message more neutral and humanizing than what banks are doing today, it may be much easier to get people's attention. So he gave an example by saying, instead of, for example, don't fall for scams, that's where you would say, no, that's not me, I don't care. But you didn't fall for scams. Criminal targeted and manipulated you. Sounds much more neutral in tone. We're not accusing you of anything. And that will make it much more acceptable from a consumer point of view to take that message. And by that way, you build a pause in emotional momentum, and that makes it much easier to convince people. Another, like, more of a joking comment he said as well, like, maybe we should give all bankers a therapy to better talk to consumers when they are being frauded or ahead of being frauded, to make sure that you can bring that message in a much more human way than what we are doing today, which is much more about warning and more accusing people of having failed and became a victim of fraud instead of the whole manipulation. Because, and that's what I was thinking about during that session, if fraud and marketing are essentially more or less the same thing, as bankers, we are both applying and prohibiting the use of those techniques. Because on the one hand, we have banks saying, for X and X reasons, you have to buy that product or you have to use that platform. On the other hand, they say, yeah, but don't fall for those tricks. And we're actually using exactly the same tricks, but with a different intent.
It's a tough one because, as you say,
Yeah,
most of that messaging that arrives in my inbox or pops up in my app,
that's
I'd be
my
going,
messaging.
yeah, I'd be going, that's not me. So maybe banks should be looking way more at the way that people do social media reels and things like that that are more emotive. And it's not just about product, this is it. Put the stories together, make it emotional, show
It's
people
different
that
from what Paul said. He said make it less emotional. Make it
really,
much more neutral, emotionally neutral and humanizing. Don't be a victim. That's emotional. A criminal targeted and manipulated you, that's more neutral.
right, I'm with you. Okay, I got the wrong interpretation of that. So he's saying make it far more neutral. So how do we communicate that to how do we get that message across to more people? Is that more emails?
I'll try to convince Paul to join us in Brussels as well. I don't know.
That I think is a great idea. I think that if we can get Paul to listen to this podcast, Paul, please come to Brussels in May next year and come and
No, but at the
share.
end, making people aware of how to approach these things, creating much more dialogue across industry, across countries to share best practices, etc. And that's probably just the beginning. It's a never-endless fight against criminals who will always find new tricks to convince us of the wrong things. It is what it is. It is part of financial services. We need to deal with it. Make sure that we can reduce fraud to the maximum.
So you mentioned the word there, carrying on in the future. So as not to make this a epic 1 hour long episode, I'm going to jump to the third bit, the article or the session that you found very interesting at Open Banking Expo. And that was very forward looking. That was very future looking, actually. 55. I mean, certainly will be retired by then,
I hope not.
retired and maybe even dead by then. I mean, I'd be 90 years old in 2055,
I hope
right?
by 2050 you'll still be working for the banking scene.
Yeah,
Otherwise, I don't see any reasons to keep working.
man, I'll be 90 years old. Nobody wants to
Well,
hear
yeah,
from
the
an
banking
old.
scene grandpa.
I am already the banking grandpa. So there were some things though that I found them strange because I thought, but hang on a minute, that's more now than 2055. So for example, finance will be modular, unbundled, and embedded anywhere. I think we're very much on the road to that anyway.
We discuss about it. We talk about it. We talk about some proof of concepts, but we're not there yet.
I don't think we're there yet, but
Not
but it's only
not at the
2025.
level that he was explaining. And that was more about getting that instant consumer. It was specifically on consumer finance. And the reason why I thought it was intriguing to write about was because his business is based on consumer finance. So part of those predictions are self-fulfilling prophecy to make sure that you can argument why you set up that business that way. And others will probably make a lot of sense. When you talk about the embedded finance and the unbundling and rebundling, this idea was that you will have a whole set of services and you can just Lego brick everything the way you want. And that is framework we have been discussing for years. I agree. It has been on conversation of all kinds of conference for years and years because that was the future of PSD2 and open finance. Can we say it's success today? I don't think so. Will it be a success tomorrow? Maybe a higher chance. I think one of the reasons why it isn't a success is because consumers don't want to build it. And the trigger to make it a success is the engagement of consumers trying to rebundle their own preferred way of dealing with, in this case, consumer finance, for example. And some of those things make sense. And I met the guy during the break after his session. And he came with the example of the overdrafts, which we discussed in the beginning of this conversation as one of the examples of success in the Brazilian open finance landscape. So it seems to be working in some regions. I can imagine that if you have a provider, an app warning you, you're getting to an overdraft, do you want to transfer some money or do you want to take a credit at a better rate than your current bank provider? There is definitely an option there. And I can imagine that if we get to a more mature agentic AI space where a computer will help you through the complexity, there may be more uptake. I just don't know whether consumers are willing to get into that level of complexity to deal with their finances. And also, I believe they should simply not get that credit, but that's another thing.
I do think that the problem is going to be, and you had highlighted it in your article, in a modular world such as what he was explaining, who's going to be liable when things go wrong?
Yeah.
That's such a tough one to answer.
Also, yeah.
That.
Yeah, you bring together several touch points. Based on that, you're going to assess alternative credit scores potentially and who's going to use what and how. And also that was another point. We will use more data points to evaluate creditworthiness. Where you could argue if it's, for example, based on a social score, what if people consciously refuse to use social media and don't have specific points, for example, to set that social score? Will you create more a different kind? Will you just transfer financial exclusion to another level? I don't know. What I thought was interesting as well, but I don't really believe in it. The whole evolution and the opportunities of tokenized assets, where each shared by 2055, the majority will be above 55 years old, which means that a very high proportion of the population will be above 60, maybe 70 years old. They will no longer be working. They may need credits to survive. Why don't we just tokenize our living room and sell part of the house to make sure that we can pay for, I don't know, what service that's needed for, I don't know, your financial well-being or whatever. I just don't know whether I understand from liquidity point of view for the people tokenizing the living room, but will there be a demand for that kind of assets? I don't know. The technology is there, but it will all depend on the uptake.
I think that the bit that worried me more than the tokenized assets was borrowing following us into old age.
Yeah.
My goodness, where he making the prediction that retirement will no longer mean debt-free living and the elderly will have mortgages bundled with healthcare and pensions and things like this. That, to me, that raises a whole societal, moral, and ethical
that's
dilemma.
true. But I think it's also cultural. There are some countries where you have cross-generational mortgages already.
Mhm.
So in some areas, it already exists, and it may just be a matter of migrating that to other regions and try to sell it and make it a success. I don't know. But a lot of it is also culturally, and some countries may be more willing than others to get into that risk
I
towards
just
their
don't
children,
think
right?
I don't think my kids would be too happy with me leaving them a massive amount of debt because I've gone on a round the world cruise while I'm still
Yeah.
able to, and then I've lumped them with the debt afterwards. Mortgage is fine because your mortgage is always
Yeah, in that
secure.
case, as a financial institution or the issuer of that credit to you will also need to take into account the creditworthiness of your children.
Yeah,
So you get into a completely different way of evaluating
credit and
credits
creditworthiness.
and consumers. And that is, I think, an interesting exercise as well for people from the community dealing with credits. The question is, how far do you want to go to cater the needs of these elderly, and to what extent do you want to keep them responsible for the assets they earn during their active living?
So and on that very depressing note about going into retirement with debt, I would like to know from any listeners who may be involved in that. I'd be interested to know whether or not the age threshold for mortgages and debts has been increasing over recent years, in line with the fact that most of us are working a lot longer. I will definitely be working full-time until I'm at least 70, whereas years ago, that wouldn't have been considered. People would have retired way before that. Hopefully, if my health holds out, I might be able to meet your 2055 deadline, Rick, and still be working when I'm 90 years old. But I'd be very interested to hear more from any listeners who are in banks.
Yep.
The way that age threshold, whether or not it's increasing, and what if they are making any plans about 70, 80, 90-year-old borrowers to be able to fund their own funerals or whatever the case is. And on that note, I think we'll draw this week's episode to a close.
Thank you very much. Speak soon.
Cheers.